Hey everyone! Have you ever wondered why financial markets react so dramatically every time the Federal Reserve, or the Fed, makes an announcement? Whether it's raising interest rates, cutting them, or launching a massive stimulus program like quantitative easing, QE, one thing is clear: the Fed's decisions impact the entire world. When the Fed hikes rates, stock markets tumble, emerging economies struggle, and even mortgage rates in different countries go up. But when it cuts rates, assets like stocks and real estate surge, and money starts flowing into riskier investments. So why does the Fed have so much power? And how exactly do its policies ripple across global markets? Today, we'll break it all down in a simple and engaging way. What is the Federal Reserve and what does it do? The Federal Reserve is the central bank of the United States, and its job is to keep the economy stable. It has three main goals: control inflation, keep prices from rising too fast, maximize employment, make sure enough people have jobs, ensure financial stability, prevent economic crises. To achieve these goals, the Fed adjusts interest rates and the money supply, using a set of powerful monetary policy tools. The Fed's key monetary policy tools. 1. Interest rate changes, hiking and cutting rates. The Fed controls the federal funds rate, which affects borrowing costs across the economy. Rate hikes, raising interest rates. Used to fight inflation by making borrowing more expensive. Slows down consumer spending and business investment. Strengthens the US dollar, USD, attracting global investors. Hurts emerging markets, which rely on foreign capital. Rate cuts, lowering interest rates. Encourages borrowing and spending to stimulate economic growth. Makes the dollar weaker, leading to capital flowing into emerging markets. Boosts stock markets and real estate prices. 2. Quantitative easing, QE, injecting money into the system. The Fed buys government bonds and assets to flood the market with money. This keeps long-term interest rates low, making it easier for businesses and consumers to borrow and spend. Stock markets and real estate prices tend to skyrocket during QE. Risk: too much QE can create bubbles and drive inflation too high. 3. Quantitative tightening, QT, pulling money out of the system. The opposite of QE, the Fed sells off bonds, pulling money out of circulation. This pushes interest rates up and slows economic growth. Stock markets tend to decline, and borrowing becomes more expensive. How the Fed's decisions impact the global economy. 1. The US dollar and exchange rates. Rate hikes stronger USD, hurts emerging markets with dollar-denominated debt. Rate cuts / QE weaker USD, helps global trade and investments. 2. Stock markets. Rate hikes, stock prices drop as borrowing becomes expensive. Rate cuts / QE, stocks rise as liquidity floods the market. 3. Emerging market economies. Many developing countries borrow in US dollars, so Fed decisions directly affect their economies. Stronger USD capital outflows, currency crises in emerging markets. Weaker USD, more investments into emerging markets, economic growth. 4. Commodity prices, oil, gold, etc. Stronger USD, lower commodity prices, oil, gold become more expensive for non-USD buyers. Weaker USD, higher commodity prices, makes raw materials more affordable worldwide. Historical examples of the Fed's global impact. 1. 2008 financial crisis and QE programs. The Fed launched massive QE programs, injecting trillions into the economy. Stock markets recovered, but wealth inequality and asset bubbles increased. 2. 2013 taper tantrum. When the Fed announced it would slow down QE, markets panicked. Investors pulled money from emerging markets, causing currency collapses in India, Brazil, and Indonesia. 3. 2022 rate hikes and global economic turmoil. To combat inflation, the Fed raised rates aggressively, strengthening the US dollar. Emerging markets and cryptocurrencies suffered heavy losses as capital fled to the US. How investors and everyday people can prepare. Follow the Fed's announcements. Their decisions impact stock markets, real estate, and inflation. Diversify your assets. Balance investments across different currencies, industries, and regions. Think long-term. Short-term market swings can be extreme, but solid investment strategies win over time. The Federal Reserve isn't just an American institution, it's a global economic powerhouse. Whether you're an investor, a business owner, or just someone trying to understand why markets fluctuate, knowing how the Fed operates gives you an edge. What do you think? Have you felt the effects of the Fed's policies in your country? Let me know in the comments. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell. Thanks for watching, and see you next time.